Mike Mayo joins us here at Post 9 to discuss these moves. So you've got this whole regulatory layer on top of these things as well. Why are you doing this now? And do you think that the market's fully appreciated some of the overarching trends that you highlight in these notes as reasons for the lower estimates?
No, I don't think the market appreciates the game-changing nature of the proposed regulations. A decade ago, I said the big banks need to protect themselves from themselves. And you know what? The regulators did it for them. So I say thank you, regulators. And I thought it was mission accomplished. And as I look at the new proposed regulations, I'm like, wow. In terms of the complexity, the addition in costs, in terms of the marginalizing of the banks, more business going outside of the banking industry, in terms of tougher rules for the U.S. than outside the U.S. And I think the banks are already going to get on a glide path to building more capital and hence a little bit less loan growth than you might have seen, less buybacks than you might have seen. But we're in the middle of a big debate. This is a comment period for the banks to talk with the regulators, and we'll see how it all plays out. But no, I don't think the magnitude is appreciated. And September is conference season for banks on Wall Street. So, look out when Jamie Dimon speaks. Just read his CEO letter and apply it to the new proposed rules. Wow, what a change in the landscape for the banks. So I thought the banks doubling capital, increasing liquidity. The loan loss has been half the level for the last decade than they were the prior few decades. Yet, I guess it's not enough. So grab your popcorn, sit back, and watch this big debate that's about to unfold.
Yeah, I asked him about these new capital rules when I spoke with him earlier this month, and he said they were hugely disappointing. You obviously seem to believe that they go too far. And one of the interesting things in your note is that you believe the feds have basically said, we're going to increase capital about 19% at the high end for some of the largest banks. You think the internal models will show that it's actually significantly higher, maybe even as much as 5-6 basis points higher than what the government is basically telling the market. And why is that? And what do you think that means in terms of just the overall estimates for credit, for buybacks, for capital buffers, and so forth?
Well, I do think the actual numbers could be higher than what the averages were, as stated by the Fed. And, first of all, you have data year to date. Second of all, the banks have a lot more data. But the most important impact of all this is marginalizing the banking system even more than it's been marginalized for the past few decades. The biggest unintended consequence with the reforms after the financial crisis was pushing so much business away from the banks. So you're pushing more business to the shadow banking industry. You don't want to see that. You're pushing more business to, trading outside of banks. And how ironic, on almost the 25-year anniversary of the failure of long-term capital, you're pushing more business outside of the banks. So what I take issue with in the proposal, it's like page 400 and something. By the way, how ironic. The goal is to simplify regulation in a document that's 1,087 pages. But that's beside the point, is that the banks will be stronger. Banks will definitely be stronger and therefore be able to support the economic system. That's the part. If you're only 1/4 of the financing, how can you support 100%, especially if you become more marginalized? So I think there's a balance here. There's a debate. The bigger lens, look, I've been doing this is my 4th decade. If you look at the 50-year record of banks, going back to Walter Wriston, CEO of Citigroup, he said countries don't go broke. And then you had losses on Latin American loans. And then after that, you had losses on commercial real estate in 1991 and TMT in 2001 and mortgages in the global financial crisis. So with the 50-year lens, you say, regulators, you're absolutely right. But with the 10-year lens, with all the reforms after Dodd-Frank, with the stress test, with the oversight, boards of directors, you, me, asking so many more questions, and the de-risking that's taken place, if you take on that last decade lens, you go, wait a minute, I thought we were done.